Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you today. As always, send your questions to Brian Rezny at ReznyWealth.com, and make sure you visit our website, ReznyWealth.com. Download any of our groundbreaking reports. Our number one downloaded report, the 3 biggest risks you must avoid now for 2024. If you're at all concerned about your portfolio, if you're concerned about the advice you're receiving, maybe you're utilizing a Wall Street style firm, bank, or an insurance company, and you've had lackluster returns in 23, in 22, maybe the last 5 years your portfolio is slightly up, but mediocre returns are prevalent, and you're realizing your money's not being managed at all. If you want to protect your money for 2024, go to ReznyWealth.com, click on the Special Reports tab, download the 3 biggest risks you must avoid now. It's a must-read for any investor who has at least $1 million portfolio and greater. If you want to learn how to avoid the conflicts of Wall Street, how to protect your retirement and hard-earned money from bad advice, and ultimately make sure that your money is not gobbled up by mediocre returns and inflation, go to ReznyWealth.com. You know, it's interesting. As we, obviously go through the tail end of 23 and we begin 24, a lot of things that we talked about on my shows in the last 12 months have come true. Wall Street, of course, got it wrong again. If you remember back in January of 23, Wall Street talked about major recession going to hit the U.S., major market collapse of 20, 30+% in drops in the equity value. None of that materialized. One of the things I want to stress to every one of our TV listeners is this. Wall Street firms are not fee-only fiduciary money managers. Banks are not fee-only fiduciary money managers. Insurance companies are not either. These firms do not legally work for you as a fee-only fiduciary money manager 100% of the time. So really what they spew on a lot of their information is self-serving in order to get you, the consumer, to buy and sell more often and do a lot of trading, or buy products they manufacture with high cost that really ultimately make your portfolio and your retirement security suffer. So again, make sure you understand where your advice is coming, and that's why we did write that 3 biggest risks report that is available on our website. If you, again, want to protect your money, make sure the advice you're getting is coming from the right source. Let's talk about the other big thing for what happened in 2023. Those mediocre returns that a lot of investors faced. I remember back in 22, we had a slight dip in the market. Most investors really had money too much invested in the wrong kind of bonds and suffered in 2022. In 2023, and I talked about this in January 1st of 23, about avoiding long-dated and intermediate-term bonds. And I talked about why we felt the equity market was going to be good in 23, and we were firmly correct. The U.S. economy continued to grow. But how did bonds really do, especially intermediate and long-dated bonds? They got clobbered again. Investors that owned too many bonds or the wrong kind of bonds suffered 10, 15, 30, 40% drawdowns or loss in their bond portfolio between 2022 and 2023. That's horrific. But again, Wall Street was pushing bonds again in January. What's interesting, as we ended the third quarter of 23, a lot of the Wall Street firms and banks started to change their tune because they realized they were completely wrong, and you, the investor, suffered. You suffered in 22 with mediocre or bad returns and losses, and you suffered again in 23. How many years are you going to allow your portfolio to suffer from improper management? Remember, Wall Street and their cronies are not your friend. Any firm that sells products, manufactures products, is not legally working for you, nor are they managing your money, nor are they giving you the best advice, because they're not fee-only fiduciaries, which are required to work in your legal best interest. Nick in Fort Myers, Florida. I've been with a big Wall Street firm for years. My returns suffered mainly due to following the 60-40 portfolio they keep recommending. What would you recommend? Nick, that's a great question. It really follows up about owning the wrong kind of bonds in 22 and 23. The 60-40 portfolio has been pushed by Wall Street for decades. And essentially all it really means is you've got 60% of your money in equities, 40% in bonds, and you always have this allocation. Folks, there's times you want to own less bonds and more cash. There's times you might want to own more bonds and less cash or less equities. Your portfolio, and Nick, the strategy deployed with your money that you've worked hard for, should be a fluid instrument. It needs to be able to adjust with economic changes, whether that's in interest rates, inflation, or the overall economy. We do not, at Rezny Wealth Management, do not believe in the 60-40 portfolio. We do believe in proper diversification. We do believe in making timely portfolio changes as the economy slowly changes from year to year in order to help better the client opportunity and to help better protect the client investments. Blindly, again, buying a bunch of bonds and oversaturating that portfolio is a recipe for disaster. I will say this, though. As we go into 2024, one of the things that we are looking at is actually increasing now the actual duration of the bonds that we own in our client portfolios. And the reason we're doing that is interest rates were raised quite a bit by the Fed. We're starting to see at the point where the economy is sufficiently slowing and inflation is abating. So what will happen is if the Fed starts reducing rates as we continue into 2024, remember, when rates go down, bond values go up. So now would be the time you may want to consider going more of an intermediate to longer term maturity on some of your bond portfolio. Phil in Naples, Florida. Glad I found your show. We are getting ready to retire. I have often heard retirees should reduce portfolio risk. Do you agree with that advice? Absolutely not. Whether you're retired or whether you're going to work for another 20 years has no impact on the risk scale you should take with your portfolio. If you're 80, you can be aggressive growth if you can handle that financially and emotionally. If you're 20 and you're very conservative, then maybe you should have a more conservative portfolio. But age has nothing to do with how much risk you should have in a portfolio. If your portfolio is properly managed, you have done a retirement plan that can build in fluctuations in markets when things maybe aren't as good as they should be, and show the next 3 to 5 years and then the ongoing 3 to 5 years after each one of those segments, that will ultimately show you how you should be invested. Because remember, if you don't make a decent return on your money and you spend your money down, you don't want to go back to Walmart as a Walmart greeter when you're 75. So making sure your portfolio makes an adequate return, but again, that doesn't mean you're doing speculation investing either. Proper management, proper risk, proper diversification can ultimately help you build and grow your portfolio and your income throughout retirement. As I made a comment earlier, inflation is abating and interest rates are going down. So again, the Fed has not officially reduced rates, but in anticipation of the Fed reducing rates, we're already seeing, the 10-year, the 30-year government treasury and other bonds, those rates are actually starting to come down and the values are starting to move up. Remember, when interest rates go up, bond values go down and vice versa, like a teeter-totter. So what I'm going to say is this: now that we're starting to see inflation abate, now that we're really seeing these interest rates starting to somewhat roll over, now is the time you want to take a look at your portfolio, the allocation you do have in bonds. You want to own more of an intermediate term or maybe some of it in a longer term duration, because you want to look for what's called total return on the value of your bond positions now. Not just the interest, but the growth potential you'll have when rates come down. That's a great opportunity for every investor. I'm going to take a quick break. Go to ReznyWealth.com. Make sure you download our groundbreaking report, The 3 Biggest Risks You Must Avoid Now for 2024. It's free. It's educational. It'll help you protect your hard-earned money from bad advice, market collapses, and really understanding what you should be doing correctly with your money. Go to ReznyWealth.com. And as always, if you're concerned about the advice you're getting and the advice you're getting just doesn't seem like it's working, call my firm for a consultation. We do manage larger portfolios of $1 million and greater, and if you'd like to talk to us about professionally managing your money, give our office a call during the week. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. As always, I hope you're enjoying today's program. We've got a lot more information. Make sure you do send your questions to Brian Rezny at ReznyWealth.com and visit our website, ReznyWealth.com, for any of our groundbreaking free reports and to sign up for instant notifications, not only about my TV shows, my radio shows, or any special articles we're sending out to people just like you so you can make better decisions around your portfolio. Let's talk about investments in other countries and how lousy the returns have suffered with more risk. One of the interesting things that happens is on a regular basis at Rezny Wealth Management, we get a lot of phone calls every day. We have a lot of people that want to hire our firm to properly manage their money. So they'll call us and they'll schedule a consultation. We sit down with them and we review their current portfolio to see really what's going on. The most interesting things that I see, and even though I've talked about this for years on my radio and my TV show, is about avoiding investing outside the U.S., at least for now. And again, I've talked about this for a long time. You can diversify your portfolio properly within the U.S. You don't have to have money outside the U.S., as an example, like Europe or in China, places that have been really lousy places to put your money for the last decade or longer. We still don't own investments outside the U.S., like in Europe, because Europe keeps coming in and out of recession almost every other year. Europe has no growth, slow growth, and really just a ton of debt, really little opportunity. So a lot of our new clients that come in, they come from the big firms, of course, the Wall Street style firms. They still have a big helping of international that has suffered for decades. And what often the comment that I get when people come in to talk to us, I've said this to our other advisor, why do we keep owning international? Brian Rezny at Rezny Wealth Management says you should avoid it. And the comment they always get back from their current firm, well, we want to diversify your portfolio. Again, folks, you can diversify properly within the U.S. You don't have to get a helping of crummy Europe in your portfolio that's going to be lackluster and more risky than the U.S. marketplace. One of the other big things that happened in 23 is growth outperformed value. And what does that mean? There's companies that are considered growth stocks, and they often are growing earnings faster than companies in the general, let's say, S&P 500. And then there's companies that are value stocks. They're undervalued in the S&P. They're not growing earnings as fast as, let's say, a growth company, but they're greatly undervalued, at least on a price point, price and earnings, price to book, things like those metrics. But growth outperformed value. What's going to happen in 24? I firmly believe we will have a market that will get a little bit more spread out. And what does that mean? I still feel growth is going to do quite well in 24, and we're positioned for that in our client accounts. But I also feel there's areas of the value sector that are going to have opportunities, and some of the returns are going to spread out into other areas, not just the high growth companies that really was the predominant factor in 23. So what I would say to every one of you investors is this. This is the time you want to look for undervalued sectors in the S&P. Some of the utilities look interesting, which we've added recently to our portfolios. Some of the areas in the medical and pharmaceutical, again, value approach, look very interesting. There's ways to diversify outside heavy growth companies, especially the big name companies that everybody seems to own. Bill in Florida. I self-managed for the last 6 years. This is harder than I thought. I would like to turn over to a money management firm. What should I look for when picking a firm? Bill, half the clients that hire my firm were self-managing their own money. And most of them didn't do a great job, and they realized it was a lot of work and really not a lot of fun when you had times that were a little bit more tense and you weren't really making a lot of money. So what do you want to look for? Ultimately, you want a firm that is a fee-only fiduciary firm, a firm that actually manages your money. What does that mean? At our firm, we're a fee-only fiduciary, and we actually manage money. We manage our money, your money, and our client money in-house. We don't sell somebody else's money management services, which is what the majority of Wall Street firms do, banks and insurance companies. So you want to make sure, is the firm fee-only? Are they an actual money manager? Are they actually managing your money given your goals and objectives? One of the other ways that will help you check out the firm you entrust your money, go to ReznyWealth.com. Click on the Special Reports tab at the top of our website. You can download for free Real Advisor, Fake Advisor. It's a report with a questionnaire. It'll help you really interview a firm, ask the appropriate questions so you can ultimately get the best answers so you can make a good decision on hiring the right firm to manage your money versus a sales organization that has lots of conflicts. Carol in Fort Myers. My husband recently passed. My current advisor wants me to sell a large amount of stock and buy an index annuity. I have heard you warn about annuities and salespeople. I need help. Carol, if you need help, give our office a call. We do manage larger portfolios of $1 million and greater. But your general question or comment is annuities are just complete garbage. The person that you are utilizing isn't an advisor at all. They're really selling a product. Annuities are commission-based products. When you sell an annuity, that person is not working as a fee-only fiduciary money manager, meaning they're not working, Carol, in your best interest. What it sounds like, Carol, is your advisor probably has to make a car payment or house payment. He wants to sell a bunch of your stock that you'll probably have to pay tax on, so he could basically then have you invest in an equity index annuity that will be garbage, you will soon figure this out, that has high cost structure, surrender penalties that could last 10, 15 years, and what you'll ultimately find is not only will your money be locked up, your returns will be mediocre at best, and you'll pay higher taxes on money you actually take out. So again, annuities and people that sell annuities are not fee-only fiduciaries, and they do not legally work for you, and they actually do not manage your money. Recessions and market corrections. Let's talk a little bit about that. One of the interesting things that happened in really throughout 23 is, again, the mass amount of predictions that we're going to have a major recession in 23. We did not. The economy actually grew at a healthy pace, well over 2.5% on GDP. That's not a recession, folks. Did we have a market correction? We had some pullbacks of 10% in 23, but did we have a real big collapse of 20 to 30 plus percent as the majority of other firms were calling for? We did not. We're not looking for a recession in 24 either, by the way. We're looking for an economy that is growing probably slower than 23, but generally speaking, remember, volatility is normal in a calendar year. But if you act emotionally to volatility and you do the wrong things with your money, ultimately you're going to suffer. So the best thing you can do, have a real investment strategy, follow that strategy. If you're unable to do that, find yourself a fee-only fiduciary money management firm like Rezny Wealth Management. Have that firm professionally manage your money. Take the emotion and the guesswork out of you doing it yourself, or getting bad advice or conflicted advice from a Wall Street firm or bank. I have to take a quick break. Go to ReznyWealth.com. When you go there, click on the Special Reports tab at the top of the website. Download for free the 3 biggest risks you must avoid for 2024. If you care about your wealth, if you care about the next pending recession, whether it's next year or the year after, the next market collapse, the demise of the dollar, and all these commercials about buy gold now. If you want to protect your money, go to ReznyWealth.com. Learn, educate yourself by reading that 3 biggest risk report for 2024. I'm going to take a quick break. I'll be right back with more questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report. The 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program, and as always, send your email questions to Brian Rezny at ReznyWealth.com. We love getting your questions. We love answering and making sure you're getting the proper advice. As you know, our show continues to the tail end here, and we get more questions that are coming in. You know, I look at a year of 2023, and it was a great year for our clients overall. And we're happy that we did the job we did for our clients at Rezny Wealth Management. But there's time for you to call our firm and become a client and have a firm that actually looks out for you and your financial well-being. And that's what real money management is all about. Which brings me to my next talking point today. The number one worst investment you could buy is an annuity. And why are annuities bad for your portfolio and bad for your retirement? Number one, annuities have insane lockups and surrender penalties to get all of your money out if you realize that you got sold a bad investment. If you buy an annuity, you often pay double the taxation than if you had a portfolio that had capital gains. Most annuities, if not all annuities, have incredibly high expense ratios, often approaching 3.5% to 4.5% every year against your actual money. So you can see why the returns on most annuities are quite lousy. You pay taxes that could be double than capital gains taxes. You could have expense ratios that could run 3.5% to 4.5% every single year. And if you want to get your money out, you may have to pay high surrender penalties to get all of your money out. That's a recipe for mediocre. If you want to learn more about why annuities and why you should avoid annuities, go to ReznyWealth.com, click on that special reports tab, and download for free why annuities are dangerous to your wealth and your retirement. Let's talk a little bit about ESG investing and why you do not want to waste your time. You probably heard ESG, environmental social governance. Is that a way to invest your money? One of the things I want to stress to every investor, at Rezny Wealth Management, we do not look at ESG investments. We look at quality investments, and remember, quality investments, the board of those companies should be doing the right things legally and socially and really for the environment. But if you buy investments that strictly go off a platform of what's called ESG, what we often find is you have investments that are mediocre in performance, and because they are really tied down on false promises of environmental help. I'll give you a great example. You could have a company in the oil and gas business that has a refiner. They actually have two refiners. They sell one refiner off to another company. So some other companies running their refiner, yet their ESG score goes up, meaning they're more environmental positive just because they sold one of their plants off. But there's another company that actually is running it. So at the end of the day, ESG is really smoke and mirrors, to be brutally honest. When you are an investor, the first thing you should do is buy quality investments at reasonable prices that have a chance to grow earnings and revenues over the foreseeable future, the next 3 to 5 years. And if you do that, you have a great opportunity to make money on your overall money. Lucy from Fort Myers, the future of investing in AI. This is the tech boom and bust that we saw in 2000. Lucy, great question. The future of artificial intelligence, which is AI, is here to stay. It's really been around for a while, but it's come into the news and the limelight really more so in the last 12 months. AI is going to be part of everybody's life if it isn't already. And ultimately, AI is not going to be the boom or bust like we saw in the tech bubble in 2000. There's really going to be great opportunity. There's going to be winners. There's always going to be losers. But we don't see the crazy valuations in AI stocks, most of them, that you saw in the tech boom and bust of 2000. Remember, back in 2000, a lot of technology stocks, especially internet stocks, were trading at valuations of 600-700 PE ratios, when the S&P was trading at, let's say, a 34 PE ratio. Those are crazy valuations. We're not seeing a lot of that today. So AI is going to be an opportunity. You got to do a lot of research and pick your opportunity winners the best you can. Tim in Naples, Florida. I own AT&T. What are your thoughts? Tim, I don't know how long you've owned AT&T, but you should sell AT&T. AT&T is a very in-debt company. I've talked about AT&T. Probably have had 100 questions on that in the last decade alone on my TV and radio shows. AT&T used to be a great company 30, 40 years ago. It's no longer a great company. Tons of debt. Low to no growth opportunity in sales and earnings. I think investors need to realize just because you bought a stock 20 or 30 years ago and it was good for a while doesn't mean that stock's going to be good forever. You have to have reasons you bought that stock, and then you have to have reasons why you're going to sell that stock. And it doesn't mean you wait 20 or 30 years to figure out those reasons. When you buy a stock, you have parameters. When those parameters reverse, that would be a sell signal for that particular stock. You might own a stock for a month. You might own a stock for 2 decades. But you need to have a sell parameter, which most people do not when they buy individual stocks. Ben in Naples, stocks versus ETFs or exchange-traded funds for an investment portfolio. What makes sense and more money? Well, neither one's necessarily going to make you more money, Ben. Stocks require a lot more work for you, the individual, and you're going to have more volatility in general when you buy individual stocks. ETFs are exchange-traded funds. They're a basket of various stocks. So you could buy, let's say, a stock that's in the pharmaceutical, like a Pfizer. You own one stock. I can buy the XLV, which is an ETF that owns Pfizer, and let's say 100 other different medical type companies and pharmaceutical companies in one. I'm better diversified. ETFs will have less volatility than individual stocks. We have a lot of new clients that hire my firm every year that come from firms that all they manage is individual stocks. And what I often find is they have 20 to 30% more volatility in an individual stock portfolio, more volatility, and they make 20 to 30% less returns over the same time frame. So if you own just individual stocks, or you're working with a money manager who doesn't diversify you properly in just individual stocks, I will pretty much assure you, you have 20 to 30% more volatility, and you're probably making 20 to 30% less returns than a portfolio that's really comprised of ETFs that are better diversified. Folks, I'm just about out of time. Go to ReznyWealth.com. As always, if you're unhappy with the way your money is being managed, you've had lackluster returns the last 2, 3, 4 years, and you want a real money manager who works for you and professionally manages your money, call Rezny Wealth Management during the week. We do manage larger portfolios of $1 million and greater. Call our office during the week for a consultation if you'd like to discuss our services, or visit ReznyWealth.com, click on the consultation tab, and we will give you a call back. As always, let us help you secure your future and your family legacy. That's what Rezny Wealth Management does best. Make sure you have yourself a safe and profitable day.